If you're running a business, you know that making big purchases is just part of the game. But what if I told you that those huge investments, new machinery, computers, maybe a company van, aren't just expenses. They're actually a really powerful way to save money on your taxes. In this explainer, we're going to break down exactly how you can turn those big-ticket assets into a massive strategic advantage.
So, you just did it. You splashed out on some shiny new equipment. It's exciting for the business, for sure, but that invoice can make your wallet hurt. Well, here's the good news. You're basically sitting on a tax-saving gold mine, and that's what we're here to do. Show you how to unlock it step by step.
All right, so the magic password here, the term you've got to get familiar with, is qualifying plant expenditure. Let's just call it QPE for short. Think of it as the official taxman's label for the money you spend on the tools of your trade, the stuff you need to actually do your business. As soon as an asset gets that QPE label, it unlocks the door to something called capital allowances, which is the official name for your tax relief.
To make this all really click, let's follow a story. Let's imagine a company called Awesome Printing Co. They've just invested a cool 100,000 ringgit in a brand new, top-of-the-line printing press. We're going to follow this one machine all the way from the day they bought it to the day they get rid of it, and see exactly how those tax savings stack up.
Now hold on, because here's where a lot of people get tripped up. The folks at Awesome Printing Co. might be thinking, great, I can just knock that whole RM 100,000 off my profit this year, right? Well, not so fast. For these big assets, it doesn't quite work that way. This is what's called a capital expenditure, which is different from your day-to-day costs like paper and ink. The tax rules say you have to spread that tax deduction out over the useful life of the asset. And that is exactly what capital allowances are for.
So what in the world counts as a plant? And no, it has nothing to do with gardening. In tax speak, a plant is basically the apparatus you use to get your business done. It's the obvious stuff, of course, like manufacturing machines, but it's also all your office equipment, computers, printers, you name it. Even the aircon units and your business vehicles fall into this bucket.
Okay, let's get to the good stuff. We're going to talk about the first major win you get. This is the part that gives you an immediate boost in the very first year you own the asset. It's called the initial allowance, or IA.
And the best part? The math is super simple. Seriously, you just take the cost of your asset, that's your QPE, and you apply the initial allowance rate, which is usually a flat 20%. And whatever number you get, that's your tax deduction for year one. Easy as that.
All right, let's plug in the numbers for our friends at Awesome Printing Co. They spent $100,000 on that press, so we take that $100,000 and we multiply it by that 20% initial allowance rate. Let's see what we get.
Boom, 20,000 ringgit. Just like that. That is RM $20,000 they can deduct directly from their taxable income in the very first year. This isn't some far-off benefit. It's immediate cash flow relief. And you know what? The savings don't even stop there.
But wait, there's more. The savings don't just stop after year one. This is where the long game comes in. After that first year, you get to claim something called the annual allowance, or AA. This is how you keep getting tax breaks from that same asset year after year.
Okay, so you're probably wondering, how does this annual allowance actually work? Well, you don't calculate it based on the original price. Instead, you use what's called the reducing balance. All that means is you take the original cost and subtract the allowances you've already claimed. It's a running total.
Let's look at the numbers together. It makes it super clear. So in year one, Awesome Printing Co. claims the annual allowance at RM $20,000. That leaves a new balance of RM $80,000. Now, in year two, they claim the annual allowance, let's use a common rate of 14%, but they claim it on that new RM $80,000 balance. That's another 11,200 deduction, and the balance drops again. And you just keep doing that, year after year, claiming more deductions along the way.
Okay, so time marches on, right? Eventually, that shiny new press is going to get old, and Awesome Printing Co. will either sell it or just scrap it. When that happens, there's one last step. The tax books for that asset have to be officially closed out.
This final step is called a balancing adjustment. It sounds a bit technical, but really, it's just the tax office's way of making sure everything is squared up at the end. It ensures that over the whole life of the asset, you claimed the perfect amount of tax relief, not too much and not too little. And it can go in one of two ways.
It's actually pretty simple. Think of it like this. If you end up selling the asset for less than its leftover tax value, you get a final tax deduction called a balancing allowance. Basically, the taxman says, oops, you didn't claim enough tax relief, so here's the rest. But if you manage to sell it for more than its tax value, you'll have a balancing charge.
That extra cash you made gets added back to your taxable income for the year just to even things out.
Okay, so you get the theory now. You see how it works from start to finish. But knowing is only half the battle, right? You've got to do it right. Smart compliance is absolutely the key to getting the most savings and, of course, staying out of any trouble.
So here's your simple checklist to stay on the straight and narrow and get every penny you're entitled to. First, keep amazing records of what you bought and when. Second, make sure you're only claiming for qualifying stuff. Remember, land doesn't count. Third, always use the right rates for your allowances. Fourth, you have to report when you sell or scrap an asset. And finally, don't mix up repairs with these. Repairs are a totally separate kind of expense. Getting these little details right is a really big deal.
And before we wrap up, here's a little insider tip for you, a real game changer. The government often offers special incentives to encourage businesses to buy certain things. So if you're investing in energy-efficient tech or automation equipment, you might qualify for something called accelerated capital allowances. This lets you write off the cost way faster. It's always worth checking if your new toy qualifies for these perks.
And that's the whole story. See? A major business expense isn't just a dent in your bank account, it's a strategic tool you can use to build a stronger business. So now that you know the rules of the game, the real question is, what asset are you going to turn into your next tax-saving tool?